So we got this comment from our viewer Josh, and where he asked if we were going to be doing any more self-employed tax filing examples for those who are cash basis or those that file on the Schedule C. And what he's referencing is this self-employed tutorial that we did on how to file a tax return if you are self-employed. Now, what Josh told us was that he has a window tinting business. It's actually a mobile window tinting business. And he did about $34,000 worth of income, and he had $5,000 worth of expenses. So we're going to do a video in which we briefly walk through his tax return and we talk about what his tax bill would be. But more importantly, we're going to discuss seven ways that he can actually cut that tax bill. So if you're looking for a video on how to cut your taxes if you are self-employed, you're in the right place. And you're going to want to make sure that you stick around for tips number 6 and 7 because they are some of the most powerful ways to cut your tax bill. Let's get to it. Welcome to Tax Chit Chat, the place where we talk all things tax all the time. So let's go ahead and jump into Josh's tax return and we'll take a look at that, and then let's go into the 7 ways that he can cut that tax bill. So here on the Schedule C, we'll go ahead and we'll put in his name, Big Josh. We can put in his profession. He's a window tinter. And then what you're going to see is that we put in NAICS code 811120. Now that specifically is the code that identifies that his business is for window tinting. Actually, it's for like window repair, but it's what window tinters would use. And Josh has a business name. It's Big Josh's Mobile Window Tinting. So we'll go ahead and we'll make sure we put that in. Now he's also going to put his address, 123 Sesame Street, and then he will indicate that he started this business in 2022, and he'll also say that he didn't have any expenses that required him to pay a 1099. So Josh's Schedule C is pretty simple at this point. He's got about $34,000 worth of income, and then he has about $5,000 worth of expenses. They're listed under this depreciation because they were tools, so we just simply expensed all the tools. So when we jump to the first page of his tax return, we can see that he's dealing with a tax bill of about $5,000. Now, let's talk about those ways that we can go ahead and cut that number down. Good record keeping and having a separate bank account. So when we look at Josh's tax return, we basically just see the sales and the tools that he paid for. But what about all that tint that was actually used to actually tint the windows? So that's actually going to probably be a cost of goods sold for him. But he didn't keep good record. They were mixed in with his personal bank account. So the one thing that we often tell people is make sure that you have a separate bank account for your business. Even if your business isn't incorporated, run everything through that account. All of your purchases, all of your income, because that makes it very easy for you to not lose track of things. So in this particular case, we're going to assume that he paid 10% of his sales in the form of the cost of goods sold. So this will drop his tax bill to $4,644, and it's going to save him $766. See how a little good record keeping can cut your tax bill? Now, I'm pretty sure that he paid for things like advertising, telephone. He drove his car to actually go ahead and service all these things. He paid for business meals, but none of those things were mentioned. And some of these tax gurus on social media and YouTube will tell you all these shady ways that you can do in order to cut your tax bill, but it's really not necessary. In my book, How to Slash Your Taxes Legally and Ethically, we talk about 111 ways that you can legally cut your tax bill. And I even have a complete section that's dedicated to those that are Schedule C or sole proprietors. So you can get a link to the book down in the description of this video, and you can also get a link to our free download, 10 tax tips for small businesses and startups that you can grab for absolutely free. So make sure you check those things out. Next up, business use of home. So let's assume that Josh's business is based out of his house, and he uses a 100 square foot dedicated office for doing all of his administrative type stuff, setting of his appointments, all of that good stuff. Well, that's going to allow him to have a home office deduction. But more importantly, what that does is that unlocks business mileage from mile 0. So let's say that he had another office or location in which he kept all of his materials and his supplies. If he were to drive from his house to that location, those miles are just simply commuting. But if his business is based out of his home, the very first mile from mile 0 that he drives to any of his locations or any of his clients, that is 100% tax deductible. So in this particular case, we're going to add on his home office deduction, and we're just going to use the simplified method. So it's 100 square feet, and he gets $5 per square feet. So that's $500. And then we're also going to add in his business mileage. And these two deductions combined are going to save him another $394 in taxes. Now, if you have any questions about any of the deductions that we go through in this video, or if you want us to do a dedicated video about any one of the topics, then make sure you drop us a comment down below, okay? The Section 179 deduction. So when you buy big ticket items such as like equipment and tools or machinery, you usually can't write that item off in the year for the year, which means that you usually have to take that deduction over the course of time through what's known as depreciation. However, in certain cases, you might be able to get a write-off via what's known as the 179 deduction. And that allows you to write off things like equipment in the year for the year. So in this particular case, we're going to assume that Josh bought a laptop, a $1,000 laptop, for use exclusively with his window tinting business. So here we add the laptop into this whole depreciation section because the 179 ends up showing up as depreciation. And this will cut his tax bill to $4,042, and it's going to save him another $228 in taxes. The self-employed health insurance deduction. So if you're self-employed and you pay for insurance premiums such as medical, dental, health, or maybe even long-term care insurance, then you might be able to get a write-off for those things. What happens is it ends up being a above the line type of deduction. It shows up in part 2 of Schedule 1. So in this particular instance, we're going to assume that Josh was paying $500 a month for health insurance, or $6,000. So here we'll add on the $6,000 self-employed health insurance deduction. And this one deduction is going to drop his tax bill to $3,546, and it's going to save him another $496 in tax. Man, we're really racking it up, aren't we? Next up, hire your kids or your family. So let's say that Josh has a son, little Josh, and little Josh is 8 years old. And occasionally Big Josh takes little Josh with him on the jobs. So he goes and, he grabs the tools from the vehicle. He may assist in getting the windows ready for tinting. He's going to do something that's age appropriate. And that's the important thing. If you're going to hire your kids or your family in your business, they have to do a task that's age appropriate. And they also have to get paid age appropriately as well. So for example, my daughter Pilar, she's 13. She helps us with like our mailing letters and our newsletters and all of those things. And she gets paid minimum wage. Now, the benefit of this is that instead of me just giving her an allowance, we actually get to put her to work and teach her the value of money. We get a write-off for actually doing that. Additionally, she now has earned income, which may allow her to actually contribute to a retirement account, which sets her up for retirement at such an early age. Now, putting your kids and your family on payroll can get really, really complicated, and we highly recommend that you work with a skilled tax professional, such as myself. They can walk you through all the potential pitfalls and traps of that. So in this particular case, we're going to add on the fact that Big Josh paid Little Josh $2,400, and we're also going to add in the $240 worth of employment taxes that Josh had to pay. And all of these things count as a write-off. So now Josh's tax bill has dropped to $2,964, and he's saved another $582 in taxes. Now, for those 2 ways that I said that were the most powerful for a self-employed individual to cut their tax bill: retirement plan contributions. So if you're self-employed, if you use certain retirement plan vehicles, such as the SEP IRA, you might be able to contribute up to 20% of your business's profit to a retirement plan. And the federal limits are crazy. So if you have enough profit, in 2022, you could have contributed up to $61,000 to your retirement plan. Now, one of our clients is actually set up as a Schedule C. They're in the consulting space. And I think he had $257,000 worth of income, which allowed him almost like a $57,000 contribution to his solo 401k. So literally, some of the most powerful ways to help reduce your tax bill are by contributing to a retirement plan. So we add in the $2,000 that Josh paid towards his SEP IRA. And what's important to know about this is that it actually doesn't show up on the Schedule C, it shows up on Schedule 1. And it actually ended up not reducing Josh's tax bill. And that's because at this particular point, he'd actually reduce his income tax bill down to 0. What he's actually stuck paying at this point is self-employment tax. But through this last tip, we'll tell you how we can even get rid of self-employment taxes. Consider choosing a different tax structure. So when you first set up your business, the easiest way to start is usually just as a sole proprietor, so you'll end up filing on the Schedule C. But from a tax saving standpoint, this actually may not be the best structure for you to actually choose. The reason why is because 1, you usually end up paying more taxes by being on a Schedule C. And 2, the audit rate for businesses that are on a Schedule C is actually higher than any of the other corporate tax structures. Now, in this particular video, we talk about the different ways that entities are taxed, and we actually discuss the tax structure for a business that is taxed the least. So you want to make sure that you check that one out. But let's say that Josh decided that he did want to be taxed as an S Corp. And in that particular case, we do recommend working with a professional because there's lots of things to consider, such as distributions, paying yourself a reasonable compensation according to IRS standards, the fact that there's going to be a completely separate tax return. So there's a lot that's involved, but hey, it can save you, as we're about to see. So when Josh does this, what he's about to do is he's actually about to get rid of his self-employment tax. And the reason for this is because the profits from an S Corp are not subject to self-employment tax. So that $2,900 that Josh was paying in self-employment tax, gone, which means that we've officially reduced his tax bill to 0. He's going to pay 0 income tax, and he's going to pay 0 self-employment tax. So the amount of tax he paid, 0, zip, zilch, nada. Now in our next video, we're going to talk about how if you elect to be taxed as an S Corp, how it can save you thousands of dollars in taxes. And when it's done, it'll be linked right up here. Now, if you like this video and you got some value from it, then please consider giving it a thumbs up, or you can say thanks by buying us a coffee. The link's in the description below, and the extra coins go towards helping us make future videos and pay for things like gear and props. So, until we meet again, remember to keep earning, keep learning, and just like that, this chat is adjourned.